Welcome to the deep dive. Today, we're going deep on something that, might seem pretty basic at first, but it can get surprisingly complex the more you think about it.
Mm-hmm.
And that is saving.
Oh, saving.
Putting money aside, maybe for a rainy day, maybe for that dream vacation.
Right.
But today, we're going to explore how saving impacts the bigger picture, like the entire economy.
It's really fascinating when you start to think about all the ways that saving kind of ripples out into the world around us,
Yeah,
right?
absolutely. And to help us unpack all of this, we're going to be using the Wikipedia article on saving as our guide.
Perfect jumping off point.
And they start us off with this definition. Saving is income not spent or deferred consumption.
Yeah.
Sounds straightforward enough, but
Yeah.
I have a feeling you have a much more insightful way to break that down for us.
Well, I think one of the key things is to understand that saving it's both an action and a result.
Okay.
So think of it like running a business.
Okay.
Saving is like your daily operations, carefully managing expenses, putting aside some profit. Right.
And then those accumulated profits, those are your savings.
Yeah.
Those are the assets that you can use for future growth or to reinvest.
Okay, so it's not just about hoarding cash, it's about building something over time.
Exactly.
I like that analogy.
Yeah, and economists even have specific terms for this. Saving is what they call the flow,
Okay.
the ongoing activity, whereas savings is the stock,
Gotcha.
like the snapshot of what you've built up at any given moment.
So like inventory for a business.
Yes.
You need that steady flow of goods coming in, but then you also need a healthy stock on hand to meet demand.
Precisely. And just like businesses want to have, a diverse inventory, there are also many different ways to save.
Right.
The article mentions deposit accounts, pension accounts, investment funds, even paying down your mortgage can be a form of saving.
Hold on, paying down a mortgage is saving. How does that work?
Well, it's all about freeing up future cash flow, right?
Right. So every mortgage payment you make, it reduces your debt, which means you'll be spending less money on interest in the future.
Oh, okay. Yeah.
It's like kind of pre-investing in your financial stability down the line.
That's a clever way to look at it.
Yeah.
So, is every penny that I don't spend considered saving them?
Well,
What about, interest I earn on my savings account?
that's where it gets a little bit nuanced.
Okay.
I mean, obviously, the interest you earn is great for your own personal finances, but economists don't always count that as new saving on, a national scale.
Okay.
They're more focused on that initial act of putting money aside, which can then be used for investment and to drive economic growth.
Gotcha. So there's a difference between personal saving and then saving that has a bigger impact on the economy as a whole.
Exactly.
This is reminding me of how businesses have to think about, their own profitability,
Yep.
but also their role in the overall market.
Yeah. Great point.
They have to think about both.
Absolutely. And that actually brings us to another crucial link, which is that saving fuels investment, which is really the engine of economic growth.
Okay, so my saving today could help a business expand tomorrow. I never thought of it that way.
Absolutely. But here's the catch.
Okay.
Savings need to be channeled effectively. So, if everyone just took all their cash and stuffed it under their mattress, that wouldn't really do much for the economy, right?
Right.
So banks and other financial institutions play a key role in kind of directing savings towards productive investments.
It's like a supply chain. You need the raw materials,
Yeah.
the savings, but you also need those logistics,
Yes.
the banks, to get those resources to where they can be used to create something new.
Perfect analogy. And now let's talk about interest rates.
Okay.
Because they act like the price signals in this complex economic marketplace,
Right.
Influencing both savers and borrowers.
Yeah. So, and this is classic economic theory. When lots of people are saving, interest rates go down, making it cheaper for businesses to borrow money and invest.
Exactly. That's the basic idea. But just like in the business world,
Yeah.
things aren't always so simple and predictable.
Right.
The economist John Maynard Keynes, for example, he argued that saving and investment aren't always so tightly linked to interest rates.
Really?
Yeah, he believed that the overall demand for money plays a much bigger role.
Huh. So saving decisions are influenced by more than just how much interest you might earn.
Precisely.
Okay, that makes things a lot more complex.
It does. And this complexity is actually crucial to understand because, as Keynes argued, saving can sometimes actually exceed investment, which can lead to economic slowdowns.
Wow. So my individual choices about saving can have unintended consequences for the entire economy.
They absolutely can.
Wow.
Which is why understanding these nuances of saving, both on a personal level and then that macroeconomic level, is so important.
This has been really eye-opening. And I'm sure our listeners are already thinking about their own saving habits in a new light.
I hope so. because we're just getting started.
Welcome back to the Deep Dive. In part one, we talked about how saving is like the lifeblood of a business and even the entire economy.
Yeah, it's really fascinating stuff.
It is. But let's shift gears a little bit now and bring it back to, your personal finances.
Excellent point, because ultimately, you want to know how saving can empower you to reach your goals.
Exactly.
Mhm.
So how can our listeners start applying all of these, economic concepts to their own life?
Well, just like a business needs a strategic plan, you need to define your financial goals.
Okay.
What are you actually saving for? A down payment on a house, maybe starting your own business, early retirement. Each of those objectives really requires a different approach.
That makes sense. You wouldn't use the same marketing strategy to launch a tech startup versus like, a local bakery, right?
Precisely. For short-term goals, like let's say buying a car, you really want to prioritize liquidity and capital preservation. So things like, high-yield savings accounts or maybe short-term certificates of deposit, uh, low risk, easy access to your funds.
But for long-term goals like retirement, you'd need a different strategy.
Absolutely. You've got time on your side, so you can afford to take on a little bit more calculated risk for potentially higher returns.
Okay.
So that's where things like, investing in stocks or real estate might make more sense.
Okay, so it's all about aligning your saving and investing strategies with your time frame and like your risk tolerance.
Exactly.
But how do you figure out that risk tolerance? That feels a little tricky.
It is. It's very personal.
Yeah.
A young entrepreneur might be very comfortable with higher risk, knowing they have time to recover from setbacks, whereas someone nearing retirement, they might want to prioritize protecting that nest egg.
It's like a business, assessing its cash flow. Like a
Hmm.
new company, they might reinvest every penny they have into growth, while a mature company might focus on dividends and stability.
That's a great analogy. And remember, you don't have to figure this all out on your own.
Yeah.
Just like businesses often consult experts, seeking advice from a financial advisor can really help you tailor a plan that fits your specific situation.
Okay, good to know. Now, the Wikipedia article also mentioned something called marginal propensity to save.
Oh, yeah.
And I have to admit, that one kind of went over my head a bit.
Okay, well, let's break it down.
Yeah.
Think of it like this. Imagine you get a bonus at work, right?
Okay.
Your marginal propensity to save is basically how much of that bonus you'd automatically put aside versus how much you might spend.
Oh, okay.
So it's like a measure of how much of each extra dollar you earn actually ends up in your savings account.
Gotcha. So while that might seem like, just a personal decision,
Yeah.
this tendency actually has big implications for the overall economy, right?
Exactly. If everyone had a really low marginal propensity to save, meaning they spent most of any extra income, that would probably boost consumer spending and drive economic growth. But if everyone saved a large chunk of their extra income, that could actually slow down the economy.
Wow. So my individual saving habits can have like a ripple effect.
Absolutely. You can think of it like a network of businesses.
Yeah.
If everyone suddenly cuts back on their spending, it can have a real impact on their suppliers, their partners, that whole ecosystem.
Yeah. This is making me think about how important it is to be intentional with my finances.
Hmm.
It's not just about my own goals, but also how my choices might fit into that bigger picture.
Precisely. And beyond just these, purely economic factors,
Yeah.
there's also a whole emotional side to saving that people often overlook.
Yeah, you're so right. The article kind of focuses on, the numbers and the theories,
Right.
but saving can be emotionally challenging too. It takes like discipline
It does.
and delayed gratification to resist those, tempting purchases.
Absolutely. It's something even businesses struggle with.
Yeah.
Should you reinvest those profits for future growth or maybe give your employees a raise today? It's a balancing act.
It's like, that saying, delayed gratification is the key to success.
Yeah.
But sometimes it just feels really hard to delay.
It definitely can, which is why, building those healthy saving habits is about more than just spreadsheets and budgets. It's about developing a mindset,
Right.
a willingness to prioritize those long-term goals over instant gratification.
That's a powerful way to put it. It's like, a company having a strong mission statement.
Mm-hmm.
It helps them make those tough decisions and stay focused on the bigger picture.
Exactly. And we're going to delve into some of those practical strategies for building those healthy habits in part 3, so stay tuned.
Welcome back to the deep dive. We've covered a lot of ground from, the economic theories of saving to like The emotional challenges we all face when it comes to managing our money.
Right, because it's not just about the numbers. It's about, understanding those psychological factors that come into play too.
Yeah.
Exactly. But now let's get down to brass tacks.
Okay.
How can our listener turn all of this knowledge, all of this theory into action?
That's the million-dollar question, right?
It is.
I mean, it's one thing to understand the concepts, but actually putting them into practice, that's where the rubber meets the road.
So give us the game plan.
Okay, first things first.
Right.
Just like a business needs a solid business plan, you need clarity on your financial goals.
Okay.
We touched on this earlier, but it's worth repeating.
Yeah.
What are you saving for? Is it a down payment on a house? Early retirement?
Yeah.
Starting that side hustle you've been dreaming of?
Right, because, just a vague goal like save more money, that's not going to cut it.
No, not at all.
You need a specific target, something to aim for.
Exactly. And once you've got those goals defined, it's time to create a budget.
Okay.
Think of it as your financial roadmap.
Right.
It outlines where your money is coming from and where it's going.
I know. Budgeting doesn't sound very exciting.
Yeah, it's not the most glamorous part of personal finance. But are there tools and apps out there that can make it, a little less painful?
Oh, absolutely. There are tons of resources available nowadays to help you track your income and expenses.
Okay, good.
The key is really finding a system that works for you, and most importantly, sticking to it.
So discipline is key, just like a business has to stick to its, production schedule or its marketing plan.
Exactly. And one of the best ways to boost your saving discipline is to automate it.
Oh, okay.
Set up automatic transfers from your checking account to your savings or investment accounts every month.
It's like setting up a direct deposit for your future self.
Precisely. And while automating definitely helps with consistency,
Yeah.
you can also supercharge your savings by being more mindful of your spending habits.
You mean cutting back on those lattes and impulse buys?
Well, not necessarily. It's not about deprivation. It's about being conscious of where your money is going.
Okay.
Could you maybe pack your lunch a few times a week instead of eating out? Or, negotiate a better rate on your cell phone bill?
It's like a business optimizing its operations, right?
Exactly.
Small tweaks here and there can lead to big savings over time.
Absolutely. And don't forget the power of negotiation.
Okay.
Whether it's your cable bill, your rent, you might be surprised at what you can save just by asking. Businesses do it all the time.
That's a great reminder. Now, we've talked a lot about saving, but the Wikipedia article also links saving to investment.
Right.
Can you explain that connection for our listener?
Of course. While saving is about preserving your capital, investing is about putting that money to work to generate a return.
Okay.
So think of it like a business expanding into new markets or developing a new product. There's some risk involved, but there's also the potential for growth.
So if you're saving for, like, a short-term goal,
Yeah.
you might opt for those low-risk investments, like bonds. But for longer-term goals, you might consider stocks or real estate, knowing that you have time to ride out any market fluctuations.
That's a good way to think about it.
Yeah.
And just like a business wants to diversify its product line, it's important to diversify your investments. Yeah.
Spread them across different asset classes to help manage risk.
Don't put all your eggs in one basket.
Exactly. And remember, you don't have to be a financial whiz to start investing. There's so many resources available to help you learn. And just like businesses often seek expert advice, a financial advisor can be a valuable partner.
Yeah.
To help you create an investment strategy that aligns with your goals and your risk tolerance.
This has been so insightful. I feel like I have a whole new toolkit now for managing my finances.
Good. I'm glad to hear that.
Any final words of wisdom for our listener as we wrap up this deep dive?
I think the most important thing to remember is that saving is a journey. It's not a destination. It's about building healthy habits that will serve you well over your lifetime. Just like a business needs that strong foundation